The 5-year rule trap, why your tax-free money might be locked. These are the Roth IRA 5-year rules that trip up retirees, new investors, and people doing conversions who assume their money is accessible when it is not. There is not one 5-year rule. There are effectively three, and each one applies to a different situation and runs on a different clock. The most widely known version is the contribution rule, to withdraw earnings from a Roth IRA without paying taxes. Two conditions must both be true. You must be at least 59 and a half years old, and your Roth IRA must have been open for at least 5 tax years. The 5-year clock starts on January 1st of the tax year for which you made your first Roth contribution. The trap that catches retirees in particular is the assumption that turning 59 and a half is enough. It is not. Someone who opens a Roth IRA at age 61 and makes their first contribution has a 5-year clock that runs until they are 66. Any earnings they withdraw before then are taxable as ordinary income, even though they are past the standard retirement withdrawal age. The 10% early withdrawal penalty does not apply since they are over 59 and a half. But the tax on earnings absolutely does. Both conditions must be met simultaneously. One does not substitute for the other. Here is a real example of how this plays out. A person opens a Roth IRA at age 61 with a $6,000 contribution. The account grows to $11,000. At age 63, they withdraw the full $11,000, assuming everything is tax-free because they are well past 59 and a half. Their $6,000 in contributions comes out tax-free, as contributions always do. But the $5,000 in earnings is taxable because the account has not yet been open for 5 years. No penalty, but a tax bill they did not expect. The fix is simple. Open a Roth IRA as early as possible. Even if the initial contribution is small, the clock starts running the moment you make your first contribution for that tax year, and starting it early eliminates this problem entirely. The second 5-year rule applies to conversions, and each conversion operates on its own independent clock. When you convert money from a traditional IRA or a 401k into a Roth IRA, those converted funds are subject to a separate 5-year holding period before they can be withdrawn without the 10% early withdrawal penalty, assuming you are under 59 and a half. This clock is different from the contribution clock in two ways. First, it resets with every new conversion. Someone who converts money in 2022, again in 2024, and again in 2026 has 3 separate 5-year clocks running at the same time, each attached to a different portion of their account. Second, the conversion 5-year clock is only about the penalty, not the tax. The tax on a conversion is paid at the time of conversion. The 5-year waiting period determines whether the converted principal can come out penalty-free before age 59 and a half. If you are already over 59 and a half when you convert, the conversion 5-year rule for penalties does not apply to you. The penalty exception for age already protects you. But if you are under 59 and a half, pulling converted funds before their individual 5-year clock expires means a 10% penalty on those funds, even though you already paid income tax on them when you converted. The third 5-year rule applies to inherited Roth IRAs, and it works differently than most people assume. When someone inherits a Roth IRA, the clock they care about is the one the original account owner started, not their own. If the original owner opened their Roth IRA more than 5 years before they died, the beneficiary can take distributions from the inherited account immediately, and those earnings are already tax-free. The inherited account carries the original owner's 5-year history with it. If the original owner opened the Roth IRA less than 5 years before dying, the beneficiary continues running the original owner's clock and must wait until it reaches 5 years before earnings come out tax-free. The conversion penalty clock disappears entirely at death. A beneficiary inheriting a Roth IRA is Never subject to the 10% penalty on converted amounts, regardless of how recently those conversions were made. The ordering rules matter in all of these scenarios. The IRS requires that Roth IRA withdrawals follow a specific sequence. Regular contributions first, then converted amounts in the order they were converted, and earnings last. Because contributions always leave first and contributions are always accessible without tax or penalty, many withdrawals never reach either conversion funds or earnings at all. Understanding this order before making any withdrawal can mean the difference between a clean, tax-free transaction and an unexpected tax bill. The rules are not complicated once you know they exist. The problem is that most people do not know they exist until the withdrawal has already happened. Opening a Roth IRA early, tracking your conversion dates separately, and understanding which 5-year rule applies to which dollars in your account is the difference between tax-free retirement income and a tax bill that shows up on money you thought was already settled.